are only a handful of trading days left for 2016. Here at the New York Stock Exchange, when we begin to hear "When the Sun Shines Nelly," we know what time of year it is. Joining me now is Tim Anderson of TJM Investments. Tim, great to have you on today.
It's nice to talk to you.
Well, we are heading into a new year, and that means we have a new administration entering the White House. Now, when it comes to the equity market reaction in terms of a Trump victory, we did get quite a rally in 2016. So given all the expectations for corporate tax breaks as well as infrastructure investment and some of the other regulations, including tax reform, what are you expecting to actually see in terms of policy?
Well, I think we have a pretty good snapshot of what his wish list or what the overall policy theme is, and it's pretty much what a lot of people would call a three-legged stool. Significant tax reform, particularly a much lower corporate tax rate that will accomplish both helping money repatriate from overseas to the U.S., which will be almost a double positive for that, without going into the details right now. A very large infrastructure spending program, which we've seen a significant interest in construction and capital goods stocks that would be major beneficiaries of, rebuilding roads and bridges, and a whole bunch of other infrastructure items I'm sure are on the list. And the third would be a much easier regulatory climate.
Well, while we're talking about what will happen in Washington, D.C., we can't have a conversation about 2017 without talking about the Federal Reserve.
Right.
Now, the central bank was more hawkish than expected at its final meeting of 2016. So what do you actually expect to see from the Fed? And I do want to throw in that Donald Trump does want to see GDP growth of 4% in the U.S. So when you weigh the new administration versus the Fed, what's realistic?
Look, there's two different topics in terms of the Fed. How many rate hikes are we going to get? And frankly, whether we get two or whether we get three, whether we get one or two or three, will be a function of how well the economy is going. So if the economy is just smoking it in the second half of the year, we could easily have 3 rate hikes. Rates would be at 1.25%. And they'd still be historically very, very, very low. So you would get that extra rate hike or extra rate hike and a half if it meant the economy was running on all cylinders. Now, the other item about the Fed, given what a number of the Fed speakers have alluded to just in the last maybe 3 to 4 days, for instance, Bullard has said that he would like to reduce the size of the Fed balance sheet. Okay? Now, that would mean that the Fed would be unwinding and maybe selling into the market some of the treasuries that they've bought throughout.
Well, Tim, you've given us your take on the Fed Reserve as well as the Trump administration. But I do want to get your take on the stronger U.S. currency we've been seeing. Now, we can't ignore that. On top of the equity market rally in 2016, the U.S. dollar has been trading higher against most of the major currencies. And even the dollar index, if you do pay attention to that, has been at 14-year highs.
Yes.
Now, a prolonged dollar strength environment isn't necessarily good all around for the global economies. So how have you factored that into your forecast?
Well, the strong dollar is obviously coming from higher interest rates and expectations of higher interest rates, and expectations that the U.S. economy will grow at a faster rate the next couple of years than it has. It's very encouraging that it hasn't really hurt oil that much, because oil is largely priced in dollars, and typically much stronger dollar will put pressure on oil. Oil is holding that low to mid 50 range, with a little bit of help obviously from OPEC and the Saudis saying, okay, Saudis are saying, well, we're not going to be as totally market share driven as we have been for the last year and a half. We're going to be a little bit more price conscious for the price of oil. And the other big thing that really has helped the strength of the dollar has been that the euro has been extremely weak. Everything's a cross rate, obviously, in foreign currencies, and the euro hovering around 104 is one of the reasons for the dollar strength.
Well, Tim, there are a lot of moving parts that we have to think about heading into the new year, so thank you for telling us about your expectations for next year.
Sure, it was nice talking with you.
Thank you.